Over the last year, gold and silver have been skyrocketing in price. And one of the most common questions that I've been getting over the last several months is, should I be investing in gold and silver? Does it have a place in my portfolio? And what has caused this huge increase in the price of these two commodities? And in today's video, I'm going to be breaking down some of the market dynamics at play, especially in the silver market, what the past can tell us about the future of silver, and my personal opinion of how it should fit into a portfolio. So the first thing is, the last time that we saw a run up like this in silver, it was in the late 1970s with the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt, and to a lesser extent, Lamar Hunt. They were all Texas billionaires who inherited a massive oil fortune from their father, H.L. Hunt. And they started buying silver, physical silver, and shipping it overseas to hold in Swiss vaults. This was a hedge against the inflation that they were seeing in the economy, in a way to help preserve their wealth. But by the mid and late 1970s, they weren't just buying physical silver. They started taking out loans to buy silver futures and production lines for silver, and were cornering the silver market to try and artificially increase the price. They were taking physical shipments of silver and they were hoarding it to create an artificial scarcity on the commodity and cause the price to increase. There were actually a lot of people who had short interests against silver at that time. So contracting the supply of silver created something called a short squeeze, which made the price go up even higher. But since those late 1970s and the Hunt brothers, there's been a lot of new regulation in the space. You can't just corner the silver market in that way. You can't corner the commodity market in that way without facing severe sanctions from COMEX. So the dynamics at play today are very different than what happened in the late 1970s. So now silver is not just an investment, it is actually used for a bunch of commercial reasons. We use it in solar, electric vehicles, and a lot of the AI data center build out uses silver as one of the main products, because silver is very good at conducting heat. And the fact that it's so good as a conductor is why it has all these applications. 50 to 60% of all the silver supply actually goes to commercial use. And one key insight is that 60 to 70% of those refined silver products come out of China. China produces 12 to 13% of the silver annually. Mexico is just ahead of them at 15% of that silver production, but China is firmly placed as the number 2 largest producer of silver, and they're firmly the number 1 consumer of silver in the entire world. And as this demand for silver continues to go up, the price of silver has started to climb. And as you may know, the world is building out tons and tons of AI infrastructure, and that means more and more demand on silver. So this spike in the silver price over the last year is not being driven by market manipulation, but actual market demand for the commodity, which is very different than what happened with the Hunt brothers. But the other main factor which was driving up the price is that there is an increased demand for silver as an investment. A lot of people are seeing the debt rise across the world and they want to hedge against that inflation risk. So gold has traditionally been the go-to commodity to hedge, but a lot of people are looking to silver as a higher upside alternative to gold to hedge that inflation risk. So we've seen a lot more physical silver trusts being created, a lot more silver ETFs being created, and that is another reason the supply of silver is so constrained and why the price is going up so much. And you might think, well, what is stopping China from just causing the price to spike? These market dynamics are very different than with the Hunt brothers. China has no incentive to spike the price. They actually use it in production. They are a net exporter of silver products. So they don't want the price to go up in their supply chain. They want the price of silver to stay low. But the demand has just been so high that the price has gone up dramatically. One thing worth noting is that silver is actually trading at a premium in the Chinese market. There is a Shanghai commodities market, and I'll leave a link to this down below, but you can see that silver price in China is actually higher than the silver price here in the United States. And they are actually dragging our price upwards over time. So they have no incentive to try and corner the market and try and cause prices to spike because the actual production of consumer goods would be more expensive for China, and they export 60 to 70% of all the refined silver products in the world. One other interesting thing is that you can see estimates of what we think the silver stockpile is in China. And the Chinese reserve of silver has been steadily dropping over time, which is indicative of this spike in demand for not just investments in silver, but the industrial use of silver across the world. So what does all this mean for your actual portfolio? What does this mean for you investing in silver moving forward or investing in gold moving forward? And I think the best way to think about this is what would a portfolio of silver and gold look like for you? So in order to back test it and really do analysis, you almost have to ignore 2025 because it was such an outlier year. So I used a website called test.folio. I'll leave a link down below if you guys want to play around with it. Usually I use Portfolio Visualizer to back test things within the last 10 years. And if I want to go back further than that, then I use test.folio. So if you ignore 2025 and you analyze a 60-40 stock silver, a 60-40 stock gold, and a 60-40 stock bond portfolio, what you will find is that from 2016 to 2024, that silver portfolio actually underperformed the gold and bond portfolios. The returns were worse, the risk metrics were worse, and overall, your outcomes were worse with a 60-40 stock silver mix. If you looked at the gold bond portfolios, the returns were very similar, and the bond portfolio actually slightly edged out gold on the risk metrics. But overall, there was nearly identical returns and pretty similar risk metrics between the gold and bond portfolios. Now, if you add in the year 2025, that turns everything on its head. Now that 60/40 stock silver portfolio way outperforms the gold and bond portfolio in the returns department. You made substantially more money holding 60/40 of silver, but it's worth noting that risk is still worse. Your risk metrics are way worse with that silver portfolio. The drawdowns for that silver portfolio were steeper and lasted longer. The longest drawdown for silver lasted 5 years, where the gold portfolio was 1.27 years and the bond portfolio was 1.9 years. So when silver is doing well, it spikes, and when it fails or falters, those drawdowns can sustain for long periods of time. So looking at that overall picture, that silver portfolio had the best returns. The next best was gold. And then third was a stock bond portfolio. And I've done a few videos on this, but I still believe that a stock gold portfolio is the best portfolio to hedge risk in today's market environment. There's far more correlation between the bond market and the stock market than there was when the 60/40 stock bond portfolio was first introduced as an idea. And that stock gold portfolio does a better job of hedging the risk, gets you better returns, and has better risk metrics than just holding bonds or just holding silver. So none of this is financial advice, but in my personal portfolio, I use gold as the hedge. And the ETF of choice for that for me is IAU. If you are interested in silver, then the silver ETF is SLV. But like I said, just chasing returns is not the way to go, because the risk that you're taking for those incredible returns is much higher than a balanced approach. And if you look at the all-time chart for silver, it just looks like a straight line up. And what goes up must come down. There's no way that silver can sustain this upward momentum. Could it last the rest of the year? Could it last 6 more months? Who knows? There is no consensus price target for where silver is going to go or where gold is going to go. But if you look at the all-time charts for these two commodities, you can see a much slower, steadier growth path for gold with less volatility compared to silver, which has experienced market manipulation and crazy spikes in the price of the commodity. And if today's video helped you sort through what you should be doing with silver and gold in your portfolio, how these things could be used to hedge risk in an investment portfolio, like the video, subscribe to the channel, and share it with somebody else who's trying to figure out if they want to invest in these commodities. Keep getting 1% better every day, and I'll catch you in the next video.